Well, the FOMC delivered a jumbo 50 basis point rate cut last week, kicking off the easing cycle stateside, giving a fillip to risk sentiment as the dust settled, with stocks notching fresh new all-time highs, albeit that rate cut acting as a stiff headwind for the dollar, which slipped to fresh year-to-date lows against a basket of peers as the curve continued to bear steepen. A thinner economic calendar awaits this week, with the data docket lacking top-tier releases, although a smattering of central bank decisions are due. Plus, we have plenty of end-of-month and end-of-quarter flows in the mix as well. Plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. So something of a quieter data docket this week, and I think most market participants will be glad of that, given how busy and chaotic things were over the last 4 or 5 trading days. Joining me on the trade-off, as always, to make sense of everything that's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you from a distinctly autumnal, if not wintry London. I've had to put my big tweed jacket on today because it is rather cold and wet outside.
Oh, tweed day, is it? Oh, it must be cold then if you've got the old tweed on. Yeah, it's end of summer. It's just gone like a light switch, really, hasn't it? It's definitely a good day for ducks.
Yes, indeed. And sadly, we are not ducks. And I was more resembling a drowned rat than a duck when I rocked up at the office this morning. But enough about that, because we've got plenty to discuss in terms of the markets. So let's get into topical thunder. Right, so there's only one place to start this week, and that is with Ryan having graffitied my notes for this segment. No, in all seriousness, it is because we need to talk about what the Fed did last week, because the easing cycle is finally underway over in the United States, and the Fed delivered a 50 basis point cut to the Fed funds rate on Wednesday evening, taking the target range for the Fed funds rate to 4.75% to 5%. Of course, both Ryan and I getting that one wrong. We expected a 25 basis point move, although we did see that continued dovish drift in market pricing. And just before the announcement itself, the OIS curve was discounting about a 2/3 chance that they would go by 50 basis points. It wasn't a unanimous decision, though. Governor Bowman dissenting in favor of a more modest 25 basis point move. I'll go and give her a metaphorical pat on the back. But the other 11 members of the FOMC were voting for that larger 50 basis point cut. Why did they go for that larger cut? Well, I think there's 2 reasons. The first is the unofficial one, in that the market bullied them into it. And the second is what the latest economic forecasts contained. The 2024 unemployment forecast is now at 4.4%, up by 0.4 percentage points from where we were in the prior forecast back in June, while the inflation forecast, that came down by 0.3 percentage points to 2.6%, and even lower in 2025 and 2026. Now, I was quite surprised that the Fed are placing so much faith in their forecasts, but they're clearly looking to get a little bit ahead of the curve, despite the fact that their forecasts are nearly always wrong. In terms of the forward guidance, well, there really wasn't any. The Fed committing to taking a data-dependent approach when considering additional adjustments, broadly in line with the stance taken by other G10 central banks. But it must be said, the accompanying dot plot implied that they would cut much faster and get back to neutral much sooner than their peers, with the median dot indicating a further 50 basis points worth of cuts this year and another 100 basis points worth of cuts in 2025. Now, of course, the problem that the Fed have here is that they've given the markets an inch, and the market is now going to try and take a mile, because the OIS curve is already pricing an even chance of another 50 basis point cut at the November meeting and around 75 basis points worth of easing in total by the end of the year. So while the Fed put is still here, I would imagine they're going to cut, if they can, at 25 basis point increments from here on in, probably until the middle of next year. But if unemployment were to rise north of where they have forecast in that SEP, or if we see inflation fall quicker than they have projected in that SEP, then all of a sudden those 50 basis point moves come back onto the table, because there is now obviously a precedent for delivering a larger cut. And that is exactly how they started the easing cycle.
Yeah, very much so. Powell said it in the press conference. They don't think they're behind the curve, but they don't want to get behind the curve, which is in plain speak that this 50 pip cut was just them covering their asses, really. So it went. We may have got the number wrong, but we said that there was a chance they could go 50. It was in the balance, and if they'd gone to 25, they would have been dovish anyway. So it was a bit of a strange one. Yeah, they've gone to 50, and then we've gone to 50, but we're going to take it down to 25 perhaps going forward. It sort of argues the point, well, why go for a 50 in the first place unless you're really worried about something? And what struck me in the press conference and in the statement was that it seemed very blasé, and it took us a long time to get into the press conference before someone actually asked, well, why a 50 over a 25? And that's when the comment came that they didn't want to get behind the curve. So it was almost like, we've gone 50, never mind, and everyone's supposed to just get on with it. But since then, we've had various data points, not major, but housing and the like, that have again pointed to why they could have gone to 25 on a soft landing basis. So it's done now. I think that's going to suck a lot of this short-term volatility that we've had coming into the Fed, that the market wanted to know when the cut cycle was going to start and how it was going to start. We've got that. We've got the path. So I think we settle down a bit from now on. But as you say, the can of worms is open for the 50s now, and we're going to play that game on every big data point.
Yes, indeed. I fully agree with that. And as you said, I mean, we had the initial jobless claims falling to a 4-month low last week. And just as Powell and all the Fed officials are talking about worrying about the labour market, we get that piece of solid data. One thing I would say just before we do move on is, a lot of journalists are asking Powell last week, are you behind the curve? Well, if you look at the market reaction to what the Fed have done, the market, I would argue, thinks that the Fed are actually ahead of the curve. This bear steepening of the yield curve that we've seen, I think the 2s10s is nudging 20 basis points as we speak, which is by far and away the widest since 2022 in about 2.5 years. This would suggest that the market has a relatively high degree of concern that actually the Fed is easing too quickly and too substantially into an economy where inflationary pressures are still bubbling away and economic growth is still very, very strong. So it's going to be interesting to see how that trade in the treasury market evolves and whether that morphs into a little bit of a tantrum at the long end of the yield curve and how the Fed manage expectations around that as well. But as you rightly alluded to, Ryan, and we mentioned earlier, the question now is not really, is it 25 or 50? It's really how quickly do we get back to these neutral rate levels?
Yeah, very much so, and it's about what's happening next with central banks. The sort of the next chapter, and I think what the Fed's done is they put the icing on the cake for the fact we're entering a global rate cycle.
Sorry, you can tell our producers had 2 weeks off, can't you? Because he'll move these graphics on in a second.
Hold it on.
Oh, there we go.
There we go. We're there. We got there eventually. Then let him off. He's had 2 hours sleep last night.
Oh yeah, that's great.
So yeah, we're entering this global cut cycle, if you like. There's very few holdouts left. Very few still hiking, like the Bank of Japan maybe. So it didn't really matter that others had already started. What matters was when the Fed had confirmed that they're going to start now. The focus is going to shift to what's coming next. We're still going to be data watching and guessing rate cut sizes, but now we need to see what really happens to the data. And I think there's 2 big risks here we need to focus on. The first one we spoke about last week, which is obviously growth and whether it's going to soft land, crash land, or go flat as it has done in Europe and the UK. The second is what inflation does now. That's the next big problem, in my opinion, for central banks. Is it's the one thing for central banks to claim victory over getting inflation back to target. It's another thing getting it to stay there. So given central banks' usual record on controlling inflation, I think there's a risk here that not many are thinking about, and that's if inflation keeps going down through those targets. It's one thing seeing inflation pullback after a shock event like we've seen with the pandemic, but it's another beast when it's low economic activity starting to see price cutting lead into a more deflationary phase. So if that happens, we then, I think, are going to get a shift from cutting rates to get them back to neutral to protect the current economic growth to then having to cut to keep growth from weakening too far. So I think it's going to be another tightrope walk for central banks now and going into 2025. So they've got another job on their hands, I think.
Yeah, well, I mean, that's why they get paid the big bucks ultimately, isn't it? To make these calls and walk that tightrope. I would quite like to see Bank of England Governor Bailey on a tightrope. That could be an interesting spectacle. Anyway, I think you're
Pay for
absolutely
that.
right. Sorry.
I pay good money to see that.
Oh, so would I. I think we could have a good crowd do a whip round for that one. But I do think you do raise an important and a serious point, and I think the conversation is going to increasingly shift to downside risks to both economic growth and inflation as we move closer and closer to the target. Although I would just say that although headline inflation is pretty much back at target here in the UK and also in Europe and close to it in the United States, albeit a little bit hotter, it is still being driven largely by the good side of the economy. And I think that may be just instilling a little bit too much complacency, given all of the geopolitical issues that are continuing to take place, and also the sticky and resilient and stubborn nature of services prices. I think it is still a little bit premature to be saying that the battle against inflation is won, and we can worry about how far below the 2% target we're going to go. But it certainly isn't going to take a lot for the market to start thinking about that. If we get one or two cooler than expected price numbers, then that's exactly where participants are going to end up.
Yeah, exactly that. As I've said, the Fed have opened a can of worms with a 50, so that's going to be the game we're going to play with all the central banks, really, be it the ECB, Bank of Canada. After the Fed, their numbers went up to a 50% chance of a 50 cut. They've already cut 3 times, so we're always going to get the market. It's always far more dovish than it is hawkish, and it's always going to try and push those buttons. But that hopefully gives us some trading opportunities.
Indeed, yes, let's hope it does. One central bank that is not in a rush to deliver rate cuts, though, is the Bank of England. The BOE's Monetary Policy Committee maintaining bank rate at 5% last week, as had been fully expected. It was an 8-1 vote in favour of bank rate holding steady. Uber dovish external MPC member Dingra voting in dissent for another 25 basis point cut, of course, following the reduction that was delivered back in August. Interestingly, it's just worth noting that the BOE, as usual, voted on the Wednesday, and their vote actually took place before the Fed's policy announcement. So there wouldn't have been any sort of influence from what the FOMC did in the MPC's decision. The statement was pretty much a carbon copy of that issued after the August decision, saying that the BOE are going to keep policy restrictive for sufficiently long in order to eradicate persistent price pressures, and also that they'll take a meeting by meeting approach to deciding the appropriate level of policy restriction. Now, of course, just to frame the September BOE decision, which came last Thursday, it came just a day after what was an arguably disappointing set of inflation data for August. Headline CPI remained at 2.2%, but when you look at those underlying price metrics, core CPI, that rose to 3.6 from a prior 3.3%, and services CPI rose to 5.6 from a prior 5.2%. Now, both of those increases are a little bit below the BOE's forecasts, and there are some base effects involved there. But I think this is starting to become increasingly concerning. Of course, this data referencing August, so you've really only got 3 or 4 more inflation prints left this year in order to actually show some significant progress in stamping out those underlying inflationary pressures. And when you think back to the August decision, we had 4 policymakers on the MPC who weren't happy to deliver a rate cut back then. They also voted for rates to remain unchanged at the previous meeting last week. And of course, with the BOE's guidance as well, the bar is actually quite a high one for them to deliver further cuts, particularly further aggressive cuts, as we've already seen from the Fed and as we're talking about possibly getting from the Bank of Canada or even the ECB if the growth outlook continues to sour. The other thing that doesn't particularly make much sense with the BOE, not that many things do these days, is the decision they made on their balance sheet. Now, every September, the BOE announce an annual review into their quantitative tightening process. Now, this is very much one for the purists, so Ryan, feel free to go make yourself a cup of coffee. But they maintained the pace of quantitative tightening at £100 billion over the next 12 months. Now, that is unchanged from where we were previously, but given the huge size of gilt redemptions that are coming due next year, that's going to see active gilt sales fall from 50 billion, where they are at the moment, to just 13 billion, 1-3, in the next 12 months. Now, that is good news for Rachel Reeves and His Majesty's Treasury, because it means the BOE are going to be crystallising fewer losses. And of course, that gives a little bit more fiscal headroom to the government. But having said that, we are still in this situation where you've got, on the one hand, bank rate being lowered, and that being designed to remove restriction and ease the overall monetary policy stance. But on the other hand, a relatively rapid pace of balance sheet runoff, which is actually tightening the policy stance and tightening financial conditions, as you can see if you look at repo usage and repo rates. So a little bit of a case where the BOE's left hand is not talking to its right, but I suppose what's new with that one? Overall, though, I think the September BOE decision just provided us with more evidence that the old lady of Threadneedle Street is going to be one of the most cautious G10 central banks in removing restriction from the economy, which should help to provide some support to the pound. Although I would caveat that by saying that we are going to have a pretty significant fiscal tightening here in the UK in about 5 weeks' time at the budget at the end of October, and that really could throw a spanner in the works in terms of the BOE and potentially cause them to have to ease a little bit quicker and a little bit more than they would perhaps otherwise desire.
Yeah, we talk about the Fed, whether they're behind the curve or getting in front of the curve. It'd be nice if the BOE actually knew where the curve was once in a while. But it was an undovish meeting. That 8-1 was pretty undovish as well. I thought it might be, maybe a 7-2 at least, just to signal that things are still on the path. But that's the BOE for you. That's the UK for you. I've said even when the inflation was going up, it's always going to be more sticky in the UK than it is anywhere else, and that's the case as it on the way down with that core number going up as well. So there's still a lot of work to do. They have got their work cut out for them. We've got energy prices going up again with the energy cap move in October, so that's going to add some inflationary pressures. We've just had today that I think it's some NHS staff have turned down another pay rise, so that's going to probably go higher again. So there's still wage pressures here. So all the different areas that they want to see inflation really coming down are not really happening yet, and that's going to keep them sticky and keep policy higher for longer. What they do from here is anyone's guess. It's always a case that if the economy starts really seeing some weakness comparable to what we're seeing in other countries, Germany, for example, then yeah, perhaps they are going to have to cut rates faster. But then we might be in a situation where the economy is coming down faster than inflation, and then they've got a real problem on their hands.
Yes, indeed, and we know how well the BOE are able to deal with, balancing delicately two sides of the economy and making those tough decisions. If there's anyone you would want at the helm, of course, it would be Andrew Bailey. Not. Right, moving on, because speaking of grim economic data, the Eurozone this morning was pretty vomit-inducing, one might say.
No, I wouldn't go that far. It was pretty sour, particularly if you're a German. The pretty mediocre index should be the new name for the PMIs. It did post some horrific numbers today. France's Olympic-driven bounce in services last month absolutely collapsed from 55 to 48.3. It was only supposed to drop 2 points to 53. Manufacturing managed a 1 pip gain, though, to 44 from 43.9. A big red flag that I saw in the details of that PMI was that firms are discounting prices for the first time since 2021, and that's going to need watching very carefully. As I mentioned in my prior topic earlier, if we start to see economies really coming down significantly, that's a different ball game for central banks. Germany is in all sorts of trouble, as we know. Manufacturing went further into contraction and service expansion slowed. Optimism really fell through the floor in that report. Job losses are increasing fourth month on the row. And the PMI report forecast a minus 0.2% GDP, what they call it their nowcast or whatever, for Q3, which would, if it came to light, put Germany in a technical recession. They'll hope that it stops at just a technical recession rather than something more deeper entrenched. The UK PMIs, they softened a touch, but they still remain above, more healthy than Europe, which will keep this pound exceptionalism going for a while longer. Now, by the time this airs, we'll know what the US has done in their PMIs, and we'll no doubt be playing a 25, 50 basis point cut game again. Obviously, PMIs aren't the be-all and end-all of economic data, but the signs are there that activity is waning further. And as I said, that's going to be a big feature for central banks into the latter part of this year and into next.
Yes, it very much is. I am going to put my neck on the line a little bit here. I reckon the chances of a 25 basis point ECB cut in October are massively underpriced. I think the OAS curve has it at about 35% at the moment. As you say, those PMIs that we got this morning were pretty grim. If you actually read into the commentary around it, they were talking about both input and output prices having eased quite substantially. So you would almost say, actually, growth risk was to the downside anyway. That is now being borne out in the incoming data. If you get a cooler than expected CPI print towards the start of next week, then you're really starting to the case for a 25 basis point cut in October really starts to make itself, particularly when you consider that the Fed going 50 in September, obviously last week, just opens the door a little bit and makes it a little bit easier for other G10 central banks to also take more forceful and more dovish action on their own part. So I know the ECB have been sort of banging this data dependent drum for quite some time now. Well, if they are data dependent, the data says that they should be cutting rates. And I would argue the data says the ECB should be cutting a lot more aggressively than the Fed are.
Yeah, we've got to remember their mandate is purely inflation. It's not economic growth, although obviously that is a big feature of every central bank. And we also got to remember that it's not just two countries, not just France and Germany, although they are two of the biggest. Spain, they even their government increased their forecast for the rest of the year for growth for GDP. They revised that up, as did France last week, though. That might be coming down after today's PMI report. So there's obviously more countries than just two, so they've got to take it as a whole. And countries like Spain are doing a bit better than they are. So it's not all the countries going the same direction, and that's obviously plays into the ECB's thinking.
Indeed, you're right. And that is, well, firstly, why setting one monetary policy stance for 20 odd countries is just folly. And the second is I would be very, very surprised if the ECB did not set monetary policy based on what's going on in Germany and France, given that they are by far the two largest economies within the bloc. But that could be a whole episode of the trade-off on its own. So let's move on to some charts in that setup. Right, so a heavy FX focus this week, but I'm just going to take a quick look at the equity space. First of all, in the aftermath of the FOMC meeting last week, we did have a little bit of a choppy day in the equity space on Wednesday. The S&P ultimately ending the day in the red despite the Fed delivering that 50 basis point cut. But as the dust continued to settle, the market beginning to buy into the equity space with a little bit more conviction, with that bull case that I've been harping on about for quite some time still remaining intact. Strong economic growth, strong earnings growth, and a forceful Fed put. And of course, we now know the strike price of that Fed put as well, and that is unemployment rising north of 4.4%. So in many ways, it was perhaps not a surprise to see the market trading to new record highs last week and building on that gain in early trade this morning, with the path of least resistance continuing to lead to the upside and momentum remaining with the bulls. I would expect dips to remain relatively shallow and continue to be seen as buying opportunities. And of course, we are just 41, 42 days from the election now. So perhaps things are going to get a little bit more choppy and we will get some more dips in which participants can buy into. But I think the other thing just to bear in mind is the three pillars of that bull case. You've got to think which one is going to be tested next. Well, it's going to be earnings growth. We are only about a fortnight away from the start of Q3 earnings season, which kicks off with the banks on the 11th of October. And I think that really is the next significant catalyst that equity participants are going to need to get their heads around. But until then, I think the path of least resistance continues to lead higher. And actually, I think that will remain so for pretty much the majority of the year. And if we were to get any dips, then I would be looking to buy into them, as I have done for much of the year.
Yeah, I think these earnings are going to be really important this time around because we've seen a good Q1, a good Q2, particularly from financials and the banks. But we had warnings. Was it? I can't remember if it was JP Morgan or Goldman Sachs warning that trading business was down 10% in Q3. So some of the forward guidance from firms in Q2 for the rest of the year was a little bit on the soft side. So it's going to be very interesting what we get from these earnings. Long way to go until that. I think if we can maintain this break above this 57.20-ish level, then we're going to kick on. But if we start to struggle around it, we can't hold a move above, then I think perhaps the market's going to go a bit sideways, and that would set up the prospect of maybe a steeper pullback as some of the longs sort of run down the clock and think if it's not going higher, we better take some profit off the table.
We shall see. Time will tell. Right, moving on to somewhere where the economy is not doing particularly well at all.
Yeah, another one. It's in the same basket, and this is a trade I've already started, albeit in very small clips so far. And I'm looking to buy dollar China, dollar yuan down into the big 7 level. Now, China has been easing to address its low inflation, property sector problems, and weakening economy, but none of that seems to really be working. So their easing has been very targeted to the problem areas rather than just blanket rate cuts. And I think the longer that goes on without seeing any decent results or positive results, the greater the risk is growing that they bring out some of the big guns. Even as I was writing this, we got a note or headline this morning saying that there's a big meeting of the PBRC and 2 of their regulatory boards may be leading to something bigger on the policy front. So if they go with something like that, then really, if they don't bring out the big guns, all that should favour, or if they do bring out the big guns, all that should favour is further yuan weakening, which is not what we're seeing at the moment. We're actually seeing it strengthen. Now, some of that may be the fallout from the dollar side of things with the Fed, but the issue I have is that it's still dropping even while other dollar pairs have stabilised. So there's some risk to this trader going long while it moves against the fundamentals, but that's reflected in my smaller trade size, and I'm happy to play this one purely on the text in this instance. Now, this 7 level is always a big one when we haven't visited it for a while, and that's what I'm looking to trade off, really. Obviously, if the PBOC or officials declare that they are letting the yuan strengthen for a particular reason, I'll be out of this very quickly, because as soon as the central bank says where they want the currency to go, it'll go there, and I don't want to be fighting those guys. Now, if the economy does soften further and they do start bringing out these big easy measures, I would expect the yuan to start weakening back to at least the 720s. So I'm looking for longs in this one I've started, and we'll see where it goes.
Yeah, I would fully agree with you, Ian, mate, to be completely honest. I think the only thing, I think short China, whether it be the currency or the equity space, is a play that I'd be looking to stay in for the long term, to be completely honest. It does seem that those issues are more structural in nature than we perhaps first thought. And, it's kind of a case of they're throwing the kitchen sink at it and still nothing is working. The only thing, of course, that you need to bear in mind, whether it be the currency or the equity space, is that China is not a normal market. And these assets do have a tendency to go wherever the government or the central bank want them to go. And I think that's important to bear in mind, as you rightly said, if the PBOC were to come out with some commentary around the desire to see the CNH or the CNY strengthen, or that they were prepared to continue to let that move happen, then of course that is where the market is going to go. So I think tight risk management is absolutely pivotal with this one.
Yeah, absolutely. And I've said it often enough with this pair. As you say, if they want to move a currency or an asset somewhere, they'll move it, and you better not be standing in their way.
Indeed, if they want to move a currency, if they want to move an asset, if they want to move economic data as well, because they basically make all of that up. Right, moving on to cable. Obviously, we discussed the BOE earlier on, and cable trading to its best levels since March of 2022 in the aftermath of the BOE's decision on Thursday of last week. And of course, you can see on the chart here what happened, almost exactly 2 years ago today with Liz Truss and Kwasi Kwarteng's mini experiment with fiscal largesse that sent cable to its lowest level since the 80s. But anyway, we've moved on quite a long way since then, and it seems that the ball is now back in the bull's court for now when it comes to the pound, particularly with the BOE plotting a much slower and steadier course back towards a more neutral policy setting than some of their G10 peers. You see those 3 levels to the upside, 133.5 and 134.30, 134.5 are the first ones to keep on the radar. 132.75 135 is the key support at the moment, given that being the prior highs that we saw towards the middle of August and also earlier on this month. I would be keen perhaps just to see another test of that level and make sure that that level holds in order to ensure that this move does have some legs to the upside. But it does appear that the buyers are in control here at the moment, and for the first time in a long time, I would be perhaps happy to be long the pound.
I've got a bit of a fear here, mate, that you're running out of colours to make different lines at. I'm not sure how many you've got in your palette, but could do with a few more on there, no doubt.
Sorry. Can we just go back to how many lines there were on your bloody chart a minute ago?
At least I'll try and keep them the same colour. But anyway,
it's not my fault. Bloomberg changes it every time you add a line.
Oh, here we go, blaming your tools again.
Yeah, bad workman and all that.
Exactly. So yeah, I think that it's definitely the pound is a dip buy at the moment, and we're seeing that borne out even more so in euro sterling at the moment, which has broken a big level and could be heading much lower as well. Cable, it's showing that rate divergence that might start to grow again, if you like. The BOE not going as fast as the Fed may be. How long it's going to last, I don't know. There's going to be a limit to this, I think, and maybe up if we get up to those 135s, 136s, that may be a road too far for this particular phase, because there's going to be a blip around the corner somewhere in the UK. So for now, as we often say, the trend is your friend. You go with it, but as soon as we start to see a pretty solid top start to form, multiple tests, then I think it might be time to look the other way.
Absolutely. Yes, the trend is your friend, and the trend in dollar yen looks like it might be turning a little bit.
Quite possibly. We might be heading for calmer times ahead as well. Last week, the question asked was when would the dollar yen stop falling, and it looked like we might have finally seen the bottom. We know now that the Fed and BOJ, we know what their stance is and what they're up to, and it looks like dollar yen might settle into something less volatile. The Fed 25-50 game finally got resolved, and we saw a bounce in dollar yen since the low posted last Monday when we did the show, and that may mark an important turn in this pair. As we mentioned, a lot of these recent moves have been driven by growth worries, the market locking in yield ahead of the Fed confirming their cut cycle, and that's finally beginning. Also, the BOJ potentially still on the hike path. That means we're over the shock and awe part of this show, and there's perhaps some plenty of reasons why we may see this pair stopping falling through the floor. Now, technically, the fact we pulled up at the 38.2 fib of the 2021 rally, easy for me to say, and reheld the 61.8 fib of the 2023 rally after the break, was really the early indication for a bottom, particularly as that happened over the Fed. Now, it's obviously easy to call a bottom when you're 400 plus pips away off a low, but that's not really the point I'm trying to make here. The bigger point is that now we've stopped falling out of bed, and the price action has given us a really solid support level to focus on. So from here, I think outside of big data shocks, we're going to see some volatility coming out of yen pairs, which means we can perhaps finally start trusting some of the short-term levels again. For the upside, we're already marking a level here at the old 50 fib at 144.50s, and we should see plenty of action around the big figures, 145, 146, and a big level that's above is 147. So from here, I'm looking to see if we consolidate into a wide range before maybe developing some short-term inter-ranges. So for me, it's 139 on the downside, 140s, and then up towards 147. That's the range I'm looking to see develop over the weeks ahead.
Yes, interesting one. I think what we've seen over the last week or so with the yen and with the BOJ is something that I'm pretty sure we flagged the risk of, well, almost 12 months ago, in that as other central banks begin to cut rates and begin to cut quite aggressively, the window in which the BOJ can hike rates is starting to close pretty quickly. And actually, we heard a little bit notably more cautious and dovish tone from Governor Ueda last week when he was saying that upside inflation risks appear to have eased and that they can mull the policy outlook in light of that easing, which has just cast some doubt on the idea that the BOJ do deliver another hike before the tail end of the year. And of course, that has softened the yen in result. And the move higher that we've seen in the long end of the Treasury curve on a yield basis shan't be helping particularly much either. So yes, I agree. It does seem like, well, a bit of a change in direction, and perhaps calmer times will prevail as well.
Yeah, and the interesting comment from Ueda and the Bank of Japan last week was that the reason they see these upside inflation risks dissipating in part has been the strength we've seen in the yen. So this move we've had from the 162s, it's not helping them on that side either. So it's always a double-edged sword, currency moves.
Absolutely. Big question. Were you up at 4 a.m. for the BOJ last Friday?
No chance, mate. Absolutely no chance.
Oh,
I know which ones are the important ones that I get up for. Don't worry about that.
I'm sure you will, and you love to tell us all about it when you do as well. Right, let's move on to our plays of the day. Right, I'm going to be looking at the dollar this week because in keeping really with that call I made on cable a moment ago in terms of buying dips, I think that selling strength in the dollar is starting to look a little bit more favourable. Obviously, the dollar index trading to a year-to-date low around 101.20 in the aftermath of the FOMC last week, although it is notable that we never actually managed to close below the prior lows that we saw around 100.6, which I think is going to be a key level to watch to the downside. That could give the bulls a little bit of hope, but I do think that headwinds facing the dollar are intensifying quite substantially, given, as we said earlier on, the Fed are likely to get back to neutral fairly quicker than their peers, even if the market is pricing in still what I think is a little bit of an overly aggressive path of policy easing, although I'd say the same pretty much for every G10 central bank at this moment in time. I'm not sure I'd be overly comfortable selling at market, but if we were to get back up towards those recent highs around 101.80, then that is perhaps where I would look to be starting to fade some of the dollar strength if it were to come back into the market. Brian, you are taking us to Scandinavia this week.
Sure am. And disclaimer first, I'm already in this long position, but it still looks valid. And I'm slightly going the other way in terms of the dollar to Michael. I'm a bit more bullish on the dollar, at least in the short term since the Fed. Dollar knock, it came through last week's Fed meeting, Norges Bank meeting, and it held an important support level down at 10.45. We've had a couple of looks under, but they haven't lasted long, nor have we managed to close and hold under there either. Bounces thus far been limited, though, up to the 10.55 level. So that's the close level to watch on the top side. I'm long down into the 45, 10.45, and I've been offloading a bit if we get up to that 10.55. I still think the 45 level is good for support, but I'll be out of that if we broke down below, call it a bit of a safety net at 10.39. Conversely, if we don't see 10.45 again, I may add by trading a break of that 10.55, 56 level, perhaps for a run up to 10.65. So I'm long in this one and looking for a bit of a rally.
Good stuff. Thank you, mate. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you and welcome back as well to Kyriakos, our producer, and congratulations again on his new arrival. All three of us will be back with another episode of The Trade-Off this time next week. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and we will see you in a week's time. In the meantime, thanks again for watching. Goodbye for now.